Welcome everyone to the Schneider Downs Wealth Management 2024 year-end market commentary with a preview of what we think we're going to see in 2025. With me as always, my colleague Sean McCann. Welcome back. Yeah, and as you can see in the background, it is a frigid Pittsburgh morning. Why I have my Master's coffee cup out. One, it's yellow. It's a stark contrast to the gray and the snow behind us. Also a reminder that spring is never far from being around the corner, and hopefully
light at the end of the tunnel, right?
Light at the end of the tunnel. Some positivity. I wanted to start the kind of the wrap up of 2024 and talking about the fourth quarter, and I think it was very, very interesting. And as I was talking with Sean previously before we got on, there's this idea, if we gave investors kind of ex ante, so forecast rather than knowing the actual results, you could have the last 45 days of 2023 or the last 45 days of 2024. In 2023, you had three asset classes that were positive: U.S. large cap equities, international equities, and bonds. United States Treasury bills. Yep. Not bonds, just Treasury bills. Bonds were negative. And you'd have inflation that was still stubbornly too high. The Fed, not cutting interest rates, or you could have the last 45 days of 2024 where you had an election of Donald Trump and J.D. Vance that, whatever your political leanings are, the consumer sentiment shot up, small business confidence shot up.
Yep.
Kind of the idea of loosening barriers to business and doing business. I think most people would have taken the last 45 days of 2024 and instead of 2023. And Sean, let them know about the results.
Well, so basically what happened, it's the last quarter of this year, which I think, in stark contrast to 2023, very different in both the year as a whole and the quarters. But fourth quarter of this year, right, we had a relatively calm October. Yeah. And then things pretty much started to heat up in November. We had the election, obviously. And as you kind of already hinted at,
best November in a long time.
True, yeah. And what we had was small caps, mid caps really kind of shoot up. A bit more speculative names like Bitcoin did really well in November. But then on the flip side, right, international equities kind of, after having what I'd say a poor October, continued to decline November. And
a lot of that had to do with Trump and the election of Donald Trump and tariffs.
Potential tariffs. Yes. and trade policy. And then in December, after what I would say has been a really great year for risk assets, more specifically U.S. large caps, kind of fizzled out at the end there, right? The narrative changed from Donald Trump and the election a bit back to the Federal Reserve, Jerome Powell, and then more specifically, not what's already happened with rate cuts, but what's going to happen next year, right? Or I guess this year now.
And so what you ended up having, right, was you had the last 45 days of 2023 had everything pretty much up double digits.
Yep.
Small cap and mid caps up 16, 17%, S&P 500 up 11. Bonds were up 6% in 45 days. So I think we bring that up as a way of reinforcing that markets can, will, and almost always are unpredictable. And the best way to combat that unpredictability is to have a really good plan that integrates both the investments, the tax piece, financial planning, and estate planning all into one, so that you are able to stay invested and capture the last 45 days of 2023, or rather stay invested so that you can capture the last 45 days. And then in return, you're invested for the first 9 months of 2024, which is where the majority of the returns came for the year. And in the piece, in the opening paragraph, I talk about something that my father used to say to my twin brother Brandon and I and our teammates, was that when he was coaching us in basketball, it's not how you start the game, it's how you finish it. And it was really good advice at the time, both in sports and in life. But there's also the flip side of that coin, which is that you run up the score so much that at the end, if you have some leakage, it still ends up.
It's like the Steelers this season.
It's like the Steelers this season. You run up enough wins. You have some leakage. You still get into the playoffs.
That's right. Yeah.
And so I think that's kind of where we ended 2024. It was if you were just going to focus on the last month, you would have been disappointed. If you're willing to take a broader view of how outstanding of a year it was, especially coming off the back of 2023, I think you're quite happy. And I make as a Browns fan, as a long-suffering Browns fan, I grew up about 30 minutes outside of Cleveland. We change things a lot. We've had 40 starting quarterbacks since 1999. We've had 12 coaches in 25 years.
Yeah.
The Pittsburgh Steelers have had 3 in 50. And I think that what we're trying to instill in our investors, our clients, our prospective clients, is that changing philosophy several times a year, in the case of quarterbacks, it's multiple times a year.
Or investment plans, whatever.
Multiple times a year with coaches. If you're going to do that, it does not lead to sustained success. Go look at the Cleveland Browns records since they started, and you will see that my beloved Cleveland Browns have not done very well. Now contrast that with the Pittsburgh Steelers, and you will see much more sustained success, much more championships, much more playoff appearances. And again, this idea of having an incorporated plan, being able to stick to it, making small tweaks along the way. Small tweaks are a good thing. Major changes very rarely ever lead to sustained success.
Right.
And I think that is the big picture takeaway. And we talk about the 3 years. 2022, it was difficult. It was the inflation had been going on, but it really flared and really spiraled upward in 2022. And you had stocks down 20 to 25%. You had bonds down 13.
Yep.
And even though this market rally really started in October of 2022, you couldn't feel it at the time.
Right.
But again, if you have this tied together plan, you can get through 2022, and then you have these outstanding rebound years, 23, 24. You've in most cases or almost all cases, you've recuperated your losses, and now you're in a position where you can look forward, right? Because the 2022s in the rearview mirror, 23 and 24 now allow us to kind of focus on what's moving forward, and really kind of trying to put 2022 as less of a focal point now that we've rebounded. And so, Sean, I think kind of taking them through, taking everyone through kind of not only what happened in the fourth quarter, but the overall returns of the major asset classes. And we can move on and talk about where we think 2025 is going to take us.
Yeah, and I think kind of just going back for a second on that message of staying invested, staying in your plan, and 2022 being a disappointing year, you would have missed out on U.S. large caps in 23 and 24 going back-to-back 25% plus years, which has maybe only happened 3 times, I think, in history. So kind of staying invested, staying to that plan is so important. But again, and as I just mentioned, U.S. large caps, I think, dominated the capital markets landscape. We had a 25% return from the S&P 500. On the small and mid-cap side, still positive.
Yeah.
Still happy with it. Low double digits. And then on the international front, international and EM, mid single digits returns. And then bonds, disappointing, I would say, although you kind of know what you're going to get because it's all, if you go do the bond math. But I think as we look forward, bonds look really attractive given where yields are, and has it backed up in the last quarter.
And I think on the fixed income front, really what is interesting is it depends on your viewpoint. Because if you're a saver, for the first time in basically 25 years, or 20 years, you're not getting punished.
Right.
And yes, bonds were, finished the year modestly positive. Looking at it, municipals are up. Municipals and the Barclays aggregate, which is kind of treasuries, agencies, kind of truly high grade taxable bonds, were both up a little bit over 1%. But the yield that you were able to get off of them is like 4 times what we were getting 5 years ago.
Right.
When you had very low yields, and at least in the taxable space, the Barclays Ag yielding sub 2%, munis kind of 1.5. Now you can get 3.5, depending on the muni side, and I think you're able to generate these really attractive returns. returns from the standpoint of, if you're a saver, you're clipping those coupons and you're able to not have to go and take more risk to fund the things that you need to fund. And I think, to your point about the volatility, stocks and bonds still too correlated, right? And I think that is a, and by correlated, we mean in the fourth quarter, stocks and bonds were both down. Historically, bonds have been this shock absorber, and that really went away in 2022, where you saw stocks and bonds down both double digits. First time that's happened in like 40 years. And then again, this year, you had bonds were positive, but they weren't quite the shock absorber in the fourth quarter. And a lot of that has to do with inflation and the Fed. And I think, Sean, could you maybe tell, for the folks that don't look at it every day or multiple times a day like we do, maybe what happened in the fourth quarter with the Fed, because I think that had a lot to do with bonds really selling off.
Yeah, right. Well, we started the fourth quarter with 2 interest rate cuts, right? I think we got 75 basis points over the first 2 cuts. Things are looking relatively well, kind of on plan. And then in December, right, we saw yields spike. And this is because the rhetoric kind of changed from the Fed, from Jerome Powell, where we did get one more 25 basis point cut in December, which gave us 100 basis points or 1% of cuts for 2024. But then what happened was, the Federal Reserve changed their tone and said, well, you know what, next year we're probably not going to do 4 more cuts or 5 more cuts. We might only do 2 cuts. And basically what happened was the bond market started to price that into next year, and then you started to see yields go up. In addition to the Fed speak, I think with Trump being elected and some of the international trade policy that he's kind of been proposing, right? Tariffs, for example, possibly inflationary. I think the bond market is telling us that those indeed might be inflationary. And when you add lower rate cut or less rate cuts and added inflation, you're going to see yields go up. And again, it's not a positive for bond
in the
prices.
short term. In the short term, I think in the long term, the setup is really good. And so that brings up kind of the long term. And so here's where we think, 2025. And again, this is all done kind of ex ante, without the benefit of a crystal ball. But we think kind of 5 themes are going to kind of permeate through markets. The first theme is, the presence of Elon Musk in both our politics, in markets, in pretty much everything, right? Since he now owns, I still call it Twitter, but X. Elon Musk kind of owns the social square, and so he has this ubiquitous presence online, in markets, and politics. Looking at the companies that he owns or that are in his supply chain of the companies that he owns, we certainly think that they're going to come to the forefront. They're the things that help us become more efficient. They are the things that are going to move things forward from a productivity standpoint. So this idea of like Elon adjacent, we think is a theme that is going to dominate 2025. The second thing that we really believe is this idea of what the incoming Trump and Vance administration is going to bring. And granted, right now they're all policies, right? They're all words. We don't know what exactly, how they're going to get implemented. Margins in the House are very slim. The Senate is a little bit, they got a little bit more comfortable of a majority there. But this idea of America first, providing businesses, unshackling businesses, whether it's drill baby drill in the energy patch, whether it's reducing the kind of the regulatory overreach or perceived overreach that they've had. Outgoing FTC Commissioner Lena Khan, who said no to just about everything. You could have been, Spirit Airlines bankrupt, didn't want to tie it up, right? There were these concerns, and so whether it's kind of loosening up the tax code, creating a more efficiency in the tax code, what the underlying sentiment is that they have promised, President Trump and incoming Vice President Vance have promised that American businesses are going to do better. And that is going to be the scoreboard to which they're going to be held to and judged. And so we really think from that perspective, small and mid-cap stocks look pretty interesting. As Sean said, they were up double digits, but they're still well off their all-time highs, and certainly from a relative basis of where they typically trade to the large cap space. Now, they don't, NVIDIA and Meta and Microsoft are not constituents in small caps.
Right.
But they have their cost of capital is at least 100 basis points cheaper in most cases because of the cuts from the Fed. You're going to have lower regulatory burdens. And I think if there is a trade war, they stand to do a little bit better because they're kind of selling into me and you and the people that will be watching this. They're not really moving.
Right.
And so I think that those are like, I think that a lot of us have been waiting for small cap and mid cap stocks to go. There was a 10-year period where they dominated, and the last 15 years have been dominated by large caps.
Yep.
As you can tell, these things are kind of cyclical in nature. So we certainly think that small and mid caps are poised to have a good year. Sean is going to kind of walk you through, since we talked about the Nvidia and the Microsoft and the AI, we had that first leg up, right? The back-to-back 25% years in the S&P were pretty much done by like 2 or 3 stocks, most of them tied to AI and semiconductor chips. There's an interesting take that we have on what the next leg up in that trade is.
Oh yeah, AI has been around, or has been the big name in the town square now for at least 2 years, and we don't think that's going away. What we do think, though, right, as we've already talked about, right, the names like Nvidia, for example, that have already run up quite a lot. We think now's the time, or at least in 2025, looking at the year ahead, we think that we need to kind of expand our horizons out of those mega cap, US large cap names that are attributable to AI, and where that really is leading us to, right, is real assets, infrastructure, energy, utilities, right? Basically the underlying infrastructure that needs to be built out in order to support the AI revolution.
All the business services that go into it. The people that make the small component screws or the fasteners, and there's so many things that go into it that are underreported because they aren't as cool as the semiconductor chip, right?
Yeah.
They don't. Their CEO doesn't have it's almost like it's like an event when Nvidia does their quarterly earnings.
Yeah.
These companies don't really do that. In a lot of cases, those companies have market caps sub $10 billion, which kind of fit into our small and mid cap theme, the drill baby drill.
Yep. Energy, there you go.
And all of the above energy solution. And I think I think what this administration will come to realize is that you're going to need solar and wind and all the renewable resources that were, I think, championed by the Biden administration, but you're also going to need more traditional baseload fuels like natural gas.
Yep.
And also you're seeing the commissioning of nuclear, which was like a 4-letter word for the last 20, 25 years.
Yeah.
Now all of a sudden, like, Microsoft is like trying to recommission like 3 Mile Island. Google's getting involved in nuclear. And again, kind of in Pittsburgh being home to Westinghouse.
Yeah.
That's exciting for our communities in Western Pennsylvania. International markets, again, I think they're trading at the widest discount that they've had in 75 years. There's an interesting chart that Bank of America Merrill Lynch put together that really kind of shows this, and it's striking. It was kind of trading within a band up until about COVID. And then you kind of had the work from home stocks, the Pelotons and the Zooms. Some of those worked out better than others. Nvidia's, the Microsofts, Netflix.
Yeah, right.
Some of those worked out well. Some of them didn't. And then you had this Nvidia, the AI stuff. So you get this like vertical almost move in U.S. stocks, and international stocks have kind of just been modestly positive-ish. And sometimes they're up double digits, sometimes they're up high single digits, but it hasn't been the return that you've seen in U.S. markets. But they still have, you can't make an Nvidia chip without ASML, which is a Dutch company that makes that helps doing the lithography. That allows Taiwan Semiconductor to
Taiwan
make
Semi, one of the biggest names.
Taiwan Semiconductor. They make all of the chips. It's in Taiwan. If you want to know why Taiwan's always in the news and is kind of like this island that is kind of being jostled about from China and the rest of the world, it's because the biggest semiconductor production company in the world resides there.
Yep.
Excitingly for America, they brought some capabilities here, mostly in Arizona. But we do think that there are some really interesting companies. All of the luxury goods outside of the United States. For the most
Louis
part.
Vuitton.
Kering, which owns Gucci. Richemont, which owns Cartier. There are these really interesting. There are pockets of interesting growth stocks. There are pockets of just interesting stocks in general. They're in international markets and they're trading at really big discounts. And we don't believe that you can abandon international markets.
Right.
And in part, again, because it's cyclical. And we're going to be out with charts that show that there are really, kind of there are long periods of time where international stocks have outperformed the U.S. and it just hasn't been recently. And
I mean, 3 of the last 5 decades, right?
3 of the last 5 decades. Now, in the 90s and this past 10 years, the outperformance has been so big that in the aggregate, it's been better. But I think what we want, again, this kind of goes back to being able to have levers that you can pull on, because markets will be unpredictable. You don't know when they're going to be there, when you're going to need something, but it serves as a reasonable hedge given where valuations are. Mm-hmm. If the S&P continues to go up, our clients are going to do well. It's the biggest position between our large cap growth and our large cap, core exposure. Our clients are going to benefit from it.
Right.
But if by chance valuations start to come under pressure and they retreat, we have built-in levers that we can pull on in the portfolio.
Yeah.
Because we're not pushing all of our chips into one basket. And then the last thing is the fixed income.
Right.
And I think that we both believe that yields are, for our clients that are in a phase where they're in distribution phase, where they don't want to deal with the volatility. And it's the best. It's been the best time for allocators to service and to really advise those clients in 20 years.
Yeah, and they continue to be more and more attractive today than even 5 years ago, or not even that long ago. I believe, generically speaking, you can get 5+% return on bonds, and I think kind of yield is your destiny when it comes to fixed income returns. And as the yields continue to go up and we continue to get re-rated higher, I just think the forward expected return continues to look more and more attractive.
The 10-year Treasury in March of 2020, at the peak of oh my gosh, this is like a plague is coming. Mm-hmm. The world is shutting down. The 10-year Treasury hit 32 basis points, 0.32% yield. It is now at 4.75% and hit 4.8%.
Yeah.
That is a giant move in less than 4 years.
4 years, yeah.
A little bit over 4 years, almost 5 years, right? To your point. Coming up on the 5th year anniversary, and this is where we are. So I think from a saving perspective, to your point, for those clients that are in distribution phase, it's not to say you don't have equities, but the fixed income is providing real yield and real income for them. And so we want to end this letter, or this commentary, in the way that kind of I talked about in the letter, is that I think you have to view the 3 years, the past 3 years, 2022, 2023, 2024, in together. And we talked about behaviorally having a plan, why that's so important, and how that leads to really good results. But I also think too, as humans, we tend to put more emphasis on the negative and less emphasis on the positive. Mm-hmm. And so we think more about 2022 than 23 and 24. We put more emphasis on December of 2024 instead of the first 11 months of 2024. It's interesting that in the last 3 years, we have survived the largest inflation spike since the late 70s, the early 80s. First sustained land war in Europe since World War II. We had a significant breakout of violence and war in the Middle East, and a following humanitarian crisis that followed. And you can focus on that, and I don't want to sit here and say that those events, especially October 7th, what happened in Israel, our hearts and minds are still with the Israeli people as they still have not gotten all of their citizens back. The unfolding, the amount of war and death that has happened, it's certainly something we don't want to put a less emphasis on that. But I think if you just focus solely on what the negative events that have happened in the last 3 years, you can miss extraordinary things that have happened. Elon Musk's SpaceX basically parallel parked a rocket coming back down from space. I mean, parallel parked it certainly better than some of the people we see parallel parking.
Honestly, better than me, probably.
Yeah, better than me and you, right? This innovation in GLP-1, where with Ozempic and Wegovy, are giving people, the millions and millions of people that suffer from diabetes and obesity, a truly healthier way forward. And then this AI and the promise of AI and can it help? Will it help be the thing that puts us over helping to solve cancer, as someone who has a family member that is suffering from cognitive decline, do we finally get the answers around dementia and Alzheimer's? Generative AI can help solve those questions. And so, yes, there have been some very bad things that have happened in the last 3 years. There have been some truly outstanding things that have happened. And if you just focus on the negative, you can miss the positive. And here at Schneider Downs, we're incredibly grateful to have the clients that we have, to have the colleagues that we have. Our family is expanding. Wealth manager Demetrius Kokalis, he and his wife Madison welcomed Crew in October, a baby boy. Our wealth manager Melissa Garcia and her husband Dan are welcoming a baby boy in February. We've had so many clients and have become grandparents again, or become their kids who are clients have become parents for the first time. It's been exciting. And so it's very easy, I think, to focus on the negative. And if you focus on negatives, you can end up making some behavioral finance mistakes as it relates to investing. There's a lot of positive going around us, and in times where things seem very negative, we have to really look and are grateful, reflect on the positives. So with that, that's our wrap up for 2024. We're anxiously awaiting spring and warmer weather in 2025 when we'll see you again, hopefully with really good results to talk about. And until then, Sean,
look forward to the next one.
Absolutely. Take care.
Thanks.